Hello everyone. Let's talk mortgage. Episode number 4. In this video, I will give you two scenarios for the same loan amount in long term, but with different interest rate and upfront financing costs. I will walk you through the decision-making process. By the end of this video, I hope you will have a better idea on how to compare two different offers and make your decision with confidence. Let's assume you wanted to borrow $400,000 and you're interested in a 30-year loan. After talking with your lender, you're given two options. First option, your interest rate is 4%, which means your monthly mortgage payment will be $1,910. For this interest rate, not only your origination fee is $0, you also receive $500 lender's credit, which you can use towards your closing cost. That is pretty sweet. Now let's look at your option number 2. In this scenario, you're offered a lower interest rate, 3.875%, which means your monthly mortgage payment is $1,881, $29 cheaper than your option 1. However, to get this lower interest rate, you are required to pay $4,000 of origination fee at closing. So which scenario is good for you? First of all, let's look at interest rate and mortgage payment. Scenario 2 has lower interest rate and lower mortgage payment. Based on this, you should favor scenario 2, right? However, let's now look at upfront costs. The upfront costs are the sum of origination fee and additional costs such as rate buy-down fee, subtract any lender's credit. Clearly, scenario 1 is a more favorable choice because not only you don't have to pay an upfront $4,000 origination fee, you also receive a $500 credit. Now what do? Some people say, yeah, why don't we look at the APR? The APR is basically an adjusted interest rate taking into consideration of how much upfront financing costs you pay in addition to interest expense. In this example, scenario 2 has interest rate of 3.875%, but because it requires additional $4,000 upfront, the APR is actually 3.96%. So the APRs for both scenarios are very similar, with scenario 2 being slightly more favorable to you. I don't know about you, but at this point, it looks like scenario 2 is a better option. But is it really? I have a different approach, which I think gives us better indication. Let's turn to the next slide. I know this is a very busy page, lots of information here, but bear with me, I will guide you through it. First of all, the small table on the left top-hand corner is a summary of the two scenarios. Interest rate, monthly mortgage, upfront costs, and APR are listed for both scenarios. The orange text box below will give you step-by-step instruction on how to compare two offers, apple to apple. The first step is to assume how long you will own the property. Let's say you will own it for 5 years. Step 2, calculate the cumulative interest expenses over the entire 5 years for scenario 1. Step 3, add scenario 1's upfront costs and his first 5 years of interest expense together. This provides you 5-year accumulative financing cost for scenario 1. Repeat step 1, 2, 3 for scenario 2. Now you can compare the total financing cost for a certain holding period for both scenarios. Let's walk through this exercise using real numbers from the table on the right. The total interest expense over 5 years for scenario 1 is $76,000 $370. With $500 credit, the total 5-year financing cost for scenario 1 is $75,870. Scenario 2 has lower interest rate. Therefore, the total interest expense over 5 years is lower, $73,912. But because it requires upfront $4,000, the total financing cost is actually $77,912. But if you hold on to this property for 5 years, you actually will save about $2,000 if you choose scenario 1. What if you hold this property longer, say 10 years? So the total 10-year financing cost for both scenario 1 and scenario 2 in this case are pretty close. So with scenario 2, you are required to pay upfront $4,000 with no significant saving by year 10. Again, I would recommend scenario 1. What about 15 years? If you hold on the property for 15 years, and if you choose scenario 2, you would save about $2,300 over the entire 15 years. But is it worth it to spend upfront $4,000 to get such small saving over such a long time? Statistically, people tend to move to a new home every 7 or 10 years. So if I were you, I would choose scenario 1 with 4% interest rate but no upfront cost. Let's say if you ended up holding the property more than 15 years, your loss is very nominal. I know this is a lot of number crunching. Don't be shy to ask your mortgage broker to help you with this analysis. So as always, be a smart consumer, do your homework, compare rates and origination costs. I recommend you check interest rate with me. You've got nothing to lose, but so much more to gain. For questions on residential mortgage application, real estate purchase and sales in Washington State, please do not hesitate to contact me. Thank you very much for listening.